Okay, what the heck just happened to the stock of Constellation Brands, STZ? This Cramer-Fave booze company, best known for selling Corona Modelo here in the U.S., although they also have a bunch of wine and liquor brands, saw its stock get obliterated today, down more than 12% in the wake of what everybody panned. Disappointing quarter. While Constellation sales and earnings both came in higher than expected, there was some real hair on the results, from margin erosion in the beer business to disappointing volumes in wine and spirits. But what really crushed the stock was the guidance. Management slashed the full-year earnings forecast from $9.60 to $9.75 per share, down to $9.20 to $9.30. All I can say is, ouch. We've got to get to the bottom of this, as Constellation stock has now come down 34% from its highs last October. These levels, maybe it's too cheap to ignore. Do not take it from me. We need to dig deeper here. So let's check in with Rob Sands, the outgoing CEO of Constellation Brands, and Bill Newlands, who's the president and chief operating officer who takes over CEO in March. Mr. Sands, Mr. Newlands, welcome back to Mad Money.
Thanks. Thanks, Jim.
Okay, Rob, I'm going to come to you first. Magnitude of the decline, an overreaction given the fact that you still made the quarter?
Yeah, I think it's a total overreaction. Number one, the quarter was a great quarter. I would say the total reaction is the change in our guidance, which was really from 935 to 950. We changed the guidance to 920 to 930. So the guidance that you quoted included 25 cents, which we had said all along needed to be deducted from the guidance. Right. But that said, it's totally a function of the change in our guidance. And the change of our guidance is also totally a function of, I would say, a disappointing or are anticipating a disappointing year on the wine and spirit side. And I think even more specifically, okay, where the disappointment is in the low end of our wine business. And that's our portfolio of wines that are under $11, basically, which that segment of the wine industry is performing very poorly. It's something that we identified actually several months ago, and we said that we were pursuing strategic alternatives for that segment of our business, and in fact we are, and expect to come to some conclusions relative to that in the near future. So I guess I would just conclude by saying that the business, the growth, even the margins are 100% intact, except for, as I said, some disappointment in the low end of the wine business. We did have a little bit of margin dilution on the beer side, which was really due to a one-time expense in the third quarter. And other than that, we're expecting margins to remain flattish at the very high level of roughly 39%.
Okay. Well, let me ask Bill. Bill, on the conference call, Pablo Zuanic, who happened to be on CNBC earlier today, he's talking about in beer, Corona Extra core brand down about 10%, Corona Light down about 20%, Modelo Especial cannibalized from Familiar. I mean, this man came on air basically and said, listen, it's not just wine and spirits, it's actually beer. And beer is starting to turn into the beer company that other beer companies are. Can you try to give us a little more perspective? Because you're growing a lot faster than the other beer companies.
So we certainly are, Jim. When you look at our beer business, our year-to-date depletions are up 9%. And as we said on the call, our December depletions, which represent 60% of the coming quarter, are actually up higher than that amount. So we're very pleased about our beer business. You know, one of the things he was alluding to is the introduction of Premier, which has gone exponentially better than anyone anticipated. We've done roughly twice the amount of Premier than we had expected to do. And that has certainly had some attachment to our other beer portfolio. But when you think about the fact that the Corona brand franchise is up 8% in depletions year to date, we've got an extremely strong brand family.
Well, he also alluded to what I wrote down the term, because I know the kind of cash flow you have. He says, listen, you got to worry about balance sheet risk. Bill, I don't know. I mean, when I see the amount of money you throw off, I'm not concerned, but maybe you can address it.
Well, one of the things we also announced today, Jim, was the fact that over the next 3 years, we're going to return $4.5 billion to shareholders in the form of either dividends or share repurchases. This is on top of any of the exercise of the warrants that we have in Canopy. So this remains a strong cash generation business, and one that, frankly, I don't understand that question. We're in a great position. We continue to be in a great position, and the strength of our beer business is going to continue to have us in a great position going forward.
Yeah, and we added, Jim, that we added to that we would also get back into our target debt to EBITDA range of 3.5 to 4.0 while we were returning the $4.5 billion to shareholders, and on the assumption that we exercise the Canopy warrants. So, I mean, I would say neither Bill nor I understand exactly what Pablo is saying in that regard.
Right. Fair enough. Well, Rob, look, the elephant in the room, actually a positive elephant. I think we have Canopy on tonight, and Canopy stock is up huge. The numbers there are extraordinary. You have bought in at a great level. Should we start thinking about let's say the growth of Canopy and stop worrying about this low-end spirits where maybe people are just trying to get high from low-end spirits, and you've got both bases covered?
Well, I think two things, okay? We do think that the health of the base business, and in particular the beer business, is critical. And I think the good news there is that it's extremely healthy with, as Bill said, 9% growth year to date. And even going into December, double-digit depletion growth. So we're very confident about the beer business and where that's heading. There's literally no change there. As far as cannabis goes, I mean, I think it's all a good news story. I mean, there's been a lot of, I would say, negative press and hyperbole about it. But the truth of the matter is the Canadian government has just come out and said that the run rate currently is roughly $6 billion, which is exactly what we said it would be. We have a roughly 20 to 30% share of that, and we're anticipating that Canopy is going to be a $1 billion in revenue business in the next 12 to 18 months. And in addition to that, okay, we said, and we still stick by this, because, as I said, there's no change. The news is actually getting even better, that the Canopy deal would be accretive by 2021. So I think we've got all the bases covered, to tell you the honest truth. And the one sore spot in the business, the low-end wine business, I can assure you that issue will be dealt with. And in fact, we were already, as I said, pursuing strategic alternatives relative to that even before this quarter. So, you know, I'd say way oversold. The stock is an absolutely fantastic value. In fact, my brother and I acquired 1 million shares in the last week or so.
Well, there you go.
1 million shares, not $1 million, not $1 million, Jim. 1 million shares. Actually, 1.1.
Well, there you go. That is the most statement buy that's ever come on Mad Money. Rob Sands, the outgoing CEO of Constellation Brands. Bill Newlands, the president and chief operating officer, who takes over as CEO in March. More than 1 million share buy. What can I say? That says more than anything we say on air. Mad Money's back after the break. Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.